everybody. This is Kristin with Flagship Title. I'm here for another episode of the Captain's Club. And I am here today with Justin Cardwell with Loan Depot. Justin, just tell us a little bit about yourself before we get started.
Sure. So I am Justin from Loan Depot here local in Tampa. Have a working a branch here locally. I've been doing mortgages for a little over 2 years. I absolutely love it. I have a 3-year-old little boy.
So cute.
Thank you. Yeah, you've seen him a few times. Yeah, I use him for my branding. So, he's great. He looks better than I do and people enjoy him. So there you go.
So our topic today is, should I refi? And I think this is a question that a lot of people have, in general, not just during a pandemic. So I thought, why not answer the questions on a broad basis and then, delve into just a little bit why now could be a good time for you. So first off, what would be good reasons to refi for a person, Justin?
So a good reason would be if you have a higher interest rate and, you bought your house a couple of years ago, maybe you have a 5% interest rate. It could be significant enough in the rate difference that it makes sense. That's the number one reason I see right now is that a lot of people that bought in 2018, maybe even the beginning of 2019, they all had rates that were mid to low 5s, maybe a high 4. And right now being in low 3s, that makes a significant difference in your payment. So that is probably reason number one, is looking at your mortgage statement, seeing where that rate is and comparing to where you are now. The second thing that kind of goes with that is if you were in a specific type of loan, like maybe an FHA loan and you're paying mortgage insurance right now, if you have built your credit up, you've made your payments on time, going to a conventional loan, even with the same interest rate, you're going to save a significant amount of money monthly just because of not paying, the potential mortgage insurance. So those are the two biggest reasons.
So when we're talking about saving monthly, how does that look in the long run? So for example, we have an FHA loan and the person's paying MI. Right. And so now they're at the point where they have the 80-20 loan to value. Right. What in the long run does that look like? Are they paying enough? Are they saving enough monthly that they're saving money long run too, versus they're just refining and adding money at the end kind of thing?
Right. So anytime I do a refinance, I try to make it look like it's in my best interest, right? If I was the one having the loan done. And so if they have built enough equity for that and they're at that 80% point, losing the MI is going to save you, let's just assume a hypothetical $150 a month. Yeah. So what I try to do is keep any refinance, anything you're adding to your loan, if you are adding to your loan, at 36 months recovery or less. So normally the first thing I'm going to ask somebody if they want to refinance, when do you plan to leave? Like, do you plan on being in the home for another year and then selling it? If so, don't refinance. If you plan to be in the home for the next 30 years, then by all means, add whatever you want to, because that difference you're going to save, now is going to build up over time. But to me, that 36-month time frame is by far the most important. I think one thing most people don't know right now is conventional loans, a lot of them are getting appraisal waivers, which means that you don't need an appraisal. It's done automatically. So if Fannie and Freddie like it, you don't need to worry about an appraisal. And you may be able to get that value that you may not have if you actually had an appraisal done. So that could be a benefit to be able to get you some more, equity into your home. And
save you money on an appraisal.
And saves money on appraisal. That's $500 in your pocket, right? So obviously that's good. Helps with the loan cost and fees and all of that stuff. But yeah, I mean, that's definitely a big reason, that you would want to look into that. The other thing is that with a conventional loan, you actually have the ability to do a single premium or pay the monthly. So whereas FHA is both and it's mandatory. So you have an upfront MI and a monthly MI. But with a conventional loan, you can actually have a single premium where you pay a lump sum either rolled into your loan or at closing, and then you don't pay MI at all, and you can have a 95% LTV, meaning that you only have 5% of equity in your home, but now you don't pay that MI. And that's a lot that I'm doing right now.
Yeah, that makes sense. I mean, when we're talking about MI, let's just, for the consumer purpose, what is the purpose of MI and how does that save the lender? So that way they understand why that's a thing and why putting more money down is putting more, skin in the game for the borrower.
Right. So MI is there to protect the lenders from you defaulting because you don't have enough equity. You're not putting enough equity into the home originally. So basically, this is what it does. And this is how I explain MI, because nobody likes MI. I don't like MI. That's why I do so much.
I don't like it either.
Right? I do almost all my loans are single premium, or I just have the seller buy it for them, right? So little strategies, but nobody likes it. It's there because it's giving you the ability to buy a home without 20% down. If there was no MI company there to help insure that so that the lender and everyone's safe, you couldn't get a home without 20% down. So when people hate it so much, they're giving you the ability to buy a home that you otherwise couldn't do because you don't have enough money to put down.
Right.
That's what they're there for. It's not a horrible thing. Nobody likes paying it, but it's there to help you buy a home that you couldn't have bought otherwise.
Right. And it's, unfortunately, in probably any industry, you have the one bad apple, and that is the reason why the MI is a thing, because people were taking advantage of that.
Absolutely. Yeah.
So
that's exactly what it is. And even with what we're dealing with right now, there's been a lot of risk variance in things because of this pandemic, and we don't know, how long are people going to be out of work? We have forbearances and all these things, and these companies have to protect themselves as well because they're insurance companies. And if all of a sudden they have all these claims on homes, it's just a big thing. So MI companies are there for a great reason. We have to have them. But again, there are little strategies and ways to get rid of it before 20%. But, that's essentially why it's there.
That's great information, I think, for consumers. Let's just touch on just one little thing before you wrap up, is what is going on now as far as refinances that you're seeing, during the pandemic. Mm-hmm. And what do you see coming in the next, 60 to 90 days as we're kind of trying to wrap up this pandemic task force and what, opening up the market and all of that?
So lenders have done the most volume they've done basically of all time in the last 2 months. A lot of that was because rates had dropped so fast before this whole pandemic thing really even started taking place, but people were already in the pipeline and now they've gotten the ability to close them. So what I think we're going to see is we're going to have more of a mixture of purchases coming back. Mm-hmm. To not go into a long thing about capacity issues, but
yeah.
But lenders had a capacity issue with so many refinances coming in. They can only do so many. You can only do so many loans total. And I think the purchase business, is going to be back. It almost has to right now, because no matter what, people are going to make changes in where they live over the summer. It's just the way it is for a school system, for work, for whatever it is. They always make a change. So the next 60 days, I think, are going to be great. Right? If you're in the real estate industry, I think it's going to be great. If you're a consumer, I think it'll be great for you as well. If you're a seller, probably really great, because I think you'll get the value that you want, because rates are so low, people can afford homes. It would be different if rates were high and the prices were high.
Yeah.
But rates are low and prices are high-ish, where they should be in our area.
Yeah.
It keeps things moving. But there's still a great opportunity to refinance. If you're working, then just get an idea as to what it is. And the biggest thing I could tell you is that if estimated what your credit score is, if you have your mortgage statement, anybody can run to see what you could potentially save without going through the whole process. You don't have to do that. Mortgage statement, estimated credit score, I could tell you exactly where you would be and if it makes sense.
Well, that's great information. And when we post the video, I am going to include Justin's contact information. So if anybody wants to ask him any questions about their current loan, maybe they want the option to refinance, or they think that you're in a good place to refinance, please contact Justin at Loan Depot. So
Awesome.
thank you for joining us today, Justin. I really appreciate it. And we will have you back, I'm sure, for another topic another day.
I look forward to it. Thank you.
Thank you, and have a great rest of the day.
You too.